Hello, everybody. This is Jim Kenny for OptionProfessor.com. This is a midweek update on some things because we did have the Fed meeting today. Everybody was kind of watching that closely, and I wanted to give you my reaction, my opinion, my views. This is June the 19th. And again, as I say before every broadcast, past performance is not necessarily indicative of future results. And short-term trading, option trading, does have substantial risk of loss. So you got to check with your clearing firm, check with your broker or your investment advisor, and your good common sense before you entertain any ideas on anything. Quick background on myself for you guys just tuning in for the first time. I'm Jim Kenny, graduate of Boston College, been involved in the investment arena for decades, have done hundreds upon hundreds of seminars throughout the nation, educating thousands upon thousands of people on the uses and risks of options, using them for limited risk speculation, cash flow strategies, as well as hedging or protecting your market against adverse market directions, either up or down. All right, now what I'd like to do is get into what's gone on here today. Quickly, we've had a Fed meeting and obviously a Fed decision. The decision basically has been to leave rates alone, but basically they indicated that they're ready to lower them for the first time in or about a decade. They're still in the 2.25 to 2.25 area on the Fed funds rate, so that hasn't changed. They have dropped the word patient, and basically that is because the inflation numbers are missing their goal, which is 2%. President Trump has been threatening to demote Mr. Powell. His answer to that was, the law is clear. My job is a 4-year contract, and he plans on filling out his contract. Again, it's very difficult for the Fed to do their job if they're politicized. So I thought it was a good idea that he came out and became very clear on it, that he was going to try to become or stay independent. With regards to the future, obviously they're going to be watching incoming data very closely. And the incoming data will be obviously on all the economic numbers that come out every month. But also I think they'll keep an eye on some big things that I'm keeping an eye on right now, which is how these earnings are going to come out for the second quarter. We had Broadcom give you some pretty lousy numbers with revenue drop and forecast further drop. And then you had Adobe come out with some pretty positive numbers. So, you have crosswinds happening there. Clarity will be coming out a lot more in the next few weeks as the earnings start coming out. Second thing I'd be keeping an eye on here is obviously this meeting with President Xi. These tariffs are having an effect on people. What kind of an effect? Well, it's kind of freezing up business spending. Because who wants to make a whole bunch of plans when they don't know what their supply line is going to look like? Even companies that are here in our nation, like New Balance, they are complaining that they have got to go overseas for some of their materials, and the tariffs are causing them problems with that. So even companies that are domiciled here are being negatively affected by the tariffs. So yeah, I think there is some feeling that the tariffs have to go. But when and if that'll happen, only time will tell. But it would be very, very positive, I think, for the market if they did, because business spending would probably pick up. And obviously, clarity is not a negative when it comes to people forecasting for the future. So this meeting at the end of the month, very big. Hopefully you'll get some truth out of it rather than just handshakes and pictures and end up with nothing. But we'll have to see. Next thing people keep an eye on, retail sales have been great. Not great. Well, let's call them very good. But they've been doing well. And they have not been a concern because the numbers have been pretty strong. And that is indicating that household spending is going to be moving up. Economic recovery or economic activities, 2/3 or 70% the consumer. So retail sales and household spending going up, these are two very positive things. GDP numbers, if the GDP numbers hang in there, that's going to be very interesting to see. And then inflation numbers, could they change? Because just now I understand that we're looking at the increased prices from the tariffs on products coming in to just be hitting the market. So the inflationary numbers could change significantly. That's probably why Powell is taking a little bit of, I see there could be trouble. I'm aware of it. We are ready to ease or be accommodative if we have to. But I'm not going to go nuts here and find out that the earnings are good, the GDP number's good, because the consumer's out there spending. And I'm not going to start cutting like a crazy man when I can see that the meeting with Xi went well, and maybe the tariffs are going to go away at some point, and that the inflationary numbers may pick up because of these tariffed goods going into our system. So, he just made a pretty big 360 in December from hiking to pausing. And I don't think he wants to go into massive easing and then have to reverse himself again if these numbers come in way different than people expect. So my view is I thought he did the proper job, which is stay the line and see if this data that's just come in has brothers and sisters, meaning if there's more of it to come, or if it is transitory. And if it's transitory, you don't want to make major policy changes based on transitory numbers. And you certainly don't want to do it if the president, who has had a history of debt that has not always been great as far as bankruptcies and defaulting on debt. So I don't know that that's the source in the political structure who should be dictating what the Fed should be doing with our monetary policy. That could be very dangerous because we already have gone from 600 and change on the S&P back in '08, right, all the way up here to almost 3,000. That's about a 5 times jump. If we go up to 3,000, if we go up to 3,500 or 4,100, that would be great, except that it's not getting less risky as higher it gets. And if we do have a rollover at some point, I don't think the Feds want to be going to be happy holding on to a hot potato created by a political situation. I think that's what's going on, but I could be wrong. Again, today is all my views and my opinions on what I'm seeing and how I see it. Now, here's another thing I see. Where is the pain trade? What does that mean? The pain trade is if the market moved, in what direction would it hurt the most people? And B of A did a survey in June that, to me, is kind of interesting because it interviewed fund managers. Now, some of the results that I have read included that equity allocation seems to be lowest since about 2009, and it had the second largest drop, I guess, in some time. So, that is one factor. And the cash levels have soared to the highest level since 2011. And the bond allocation is the highest since 2011. And a record amount of people are saying on a percentage basis that the dollar is overvalued. I also heard a statistic from another source that over 80% of the people surveyed thought we were in late cycle. When you get that many people on one side of the coin, we've gone from, and I'll get this up there for you right now, because this is going to be interesting. This is the 10-year Treasury. And I'm going to get that up there for you so you can see it. And then I'm going to tell you a little bit of something that could be interesting to keep an eye on. Let's see, 10 Treasury. Okay, hang on one second. I'll get that up here for you. I share the screen here. Okay, let's start again. Okay, 10-year Treasury. Well, anyway, as I get it up, let me explain that the 10-year Treasury has really dropped in yield. And you're going to see a chart on it in a moment here, hopefully. And here it is. Okay, great. On exactly how much it's dropped. People are talking about cutting interest rates. I mean, the bond market's already cut them. I mean, take a look there. We were at 325 here in December, November, December, right? And then where are you at? You're down here at almost 2%, right? So that's a 125 basis point drop. Okay. And I don't know what the RSI is, but if this low is being made with a higher RSI, this could be a situation where I'd watch this very closely. Because again, these numbers are going to be very important that come out in the next few months. This third quarter is very, very critical because sometimes it's a very weak quarter. July, August, September, sometimes I've seen some pretty good volatility. And again, we'll have to see. But, when people say the Fed's going to cut rates, hey, the market's cut them already for them down to 125 points. So we've already, this could be a very much sell the rumor buy the fact, even if it does materialize. And again, we have the highest bond allocation since 2011. So we got plenty of people in here, all bought, because that's what happens when the prices drop, the bonds go up in price. So boom, 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 all the way down here. So if the news changes at all, and these people want to get out, all these people are in, right? And when they want to get out, they want to get out for a reason, you could pop back up to 250 here. Not that difficult. Again, retail sales is not indicating that we're in some recession by any stretch of the imagination. And it's 2/3 of economic growth, the consumer spending. I don't forget that. Okay. Now you can't fight the Fed or you can't fight the tape. So obviously this is very much in a downtrending interest rate market. So obviously, you'd like to see some turnaround, maybe above the 215 area before you'd start thinking, or even 225 before you start thinking that a bear market rally might be going on here, or let's call it a reverse rally. Okay. So that's the interest rate story there. Now, again, so where would the pain trade be on this? Well, obviously, since everyone has been buying, and everyone's bonds have gone up in price, obviously dropping the price and the yields rising look to me like it might be the pain trade. So you got to be careful of that. When things go in one direction long enough, obviously you do exhaust the volume on that side at some point. And then, of course, when people want to go out the other way, you can have what they call an order imbalance. And that's how you get sometimes some spiky moves. Now, I also said that the S&P. So let's talk about the stock market right now. S&P. It tried to get going earlier after the announcement, and then it kind of bounced around here and it kind of closed. Let's put a one-day chart up here so you can get exactly idea what the one day looks like. And after the announcement, you'll see it's try to do some volatile situations here, back and forth. So the announcement comes out at about 2 p.m. and there you are at 2 p.m. The first move was way up to 29.30, and then back down to 29.20, then back up to 29.31, and then a move back down here at the end a little bit to 29.26. Now, the good news here is the moving averages on the S&P are inverted and they're pointing up. So now, I have been saying, if people who've been going consistently here, that when we went down to here, you see this 23.50, and the moving average was at 2,750. I thought we could snap back, which is what we did. Then after we snapped back and the market remained firm, I thought we'd go back and test the area of the high, which we did. So the 29.50 area has been my line in the sand, and it has held up so far. We dipped back down to 27.33, and now we've tried to make an advance back up. Again, there's your moving averages, 27.75, 28.74. So obviously, if you get under the 50-day, that would be a yellow flag. And if you get under the 200-day, that might be a red flag. So again, but they are inverted to the upside. So technically, from the moving average standpoint, things are looking fine. The other thing is like I was saying, with these numbers of cash levels so high, equity allocation so low, that if any of these things I mentioned, earnings, GDP numbers, retail sales again, the meeting with Xi going well, and maybe the tariffs going away, that could be the flame that lights the fuse that would blow us through 29.50. Again, as I've been talking about before, my red zone where I thought the market would peter out was the low was 29.50, which is the high, which is basically how it has stopped, but also an overshoot up towards 3,100. So we could easily get an overshoot if we can break through this 29.50. So you have to be careful of that. And with, again, some of these numbers on participation levels being so low, I think the pain trade looks like it could be to the upside. And if we break 29.50, I would think the odds of that being the case would increase significantly, particularly if it's connected to an actual situation. Again, if we start breaking above 29.50 and go in some kind of run, I think that would obviously lower the Fed's reasoning to do any cutting, if at all. Maybe you get a quarter point, something nominal, but not anything massive. And I think that's what they're waiting on. They're waiting on to see how this third quarter unfolds. Everyone's thinking it's going to be a nightmare. But then again, Adobe came out and made some earnings announcements that were pretty good. And so if these companies announce that they're not doing badly, and with the retail sales and the household spending up, it's not a bad bet that that might be the case. So again, if we break through 29.50, my top side after that would be about 3,100. So the let me just go back here and go over something else here. Yes. Okay. What did the price of gold do today with all this stuff going on here? Let's take a look at GLD. And GLD was up to 127.89, the all-time high. Well, it's made its 52-week high today, but not by a lot. But it is, obviously creeping up. What has that done to the gold stocks? Let's look at GDX and the juniors and see what's going on there. Okay, GDX at 4. So again, this neighborhood here is going to be very important for the gold stocks. Can you see it's been up here before? Now it has broken up to a new high. It does have a little breakaway, runaway gap going on there a little bit. But it is a situation where if it cannot hold here, if it cannot substantially stay up to 24 or better, I would not be surprised to see a little bit of a pullback because the dollar's still very strong and he's telling you the inflation is nowhere to be found. Now, if the dollar were to drop, like many people are predicting it will, and if the inflation numbers pick up because these tariffed goods go into our system and raise prices, then I think the case for gold will increase dramatically. Paul Tudor Jones was on file here, I guess, in the last week or so, saying that if we break above 1,400 on the spot price, that going to 1,700 rapidly could be in the cards. Because if you look at a graph on the gold, the actual spot gold price, it has not been above 1,400 for quite a long time. And if it gets above there, obviously everybody who's short or out may start taking positions, or there could be a lack of seller environment because if it goes above 1,400 for a reason, it has been in this sideways action for a while. So there is somewhat of a base for it to take off from. Right now, I'm a little suspicious because the popularity of it has gone up so high, and the fundamentals of dollar and inflation don't seem to be coinciding with a rush into the metals. Now, of course, that information can change. Maybe these people are getting ahead of it. That's good for them. But if they're getting ahead of it and it's not going to happen, they might be left holding the bag or at least be involved in a pullback. All right. Let's see what I wanted to also go over with you. And that is, I'd like to go around the horn real fast and let's see how some of the sectors did today. I'm going to be using the Vanguard ETFs as a example only. There's many ETFs out there. I'm just looking at these guys. That's all I'm doing is I'm using them for illustrative purposes. Okay, let's talk about the financials. So how'd the financials do after this news came out? Let's see how they closed. They didn't like it too much because lower interest rates, as you can see from Europe, is not the cat's meow, right? I mean, if lower interest rates was the panacea, why is Deutsche Bank almost $6 away from having their stock go to zero? And why is the economy in Europe so dicey that Draghi's talking about further easing? He never even did any tightening. And so, how long can you buy your own securities? How long can you buy your own stocks and keep the market going? Ask Japan. They've been doing it for a long time. But again, the Japanese economy and GDP is certainly nothing to write home about. And I'm sure they have some risk in there because their debt to GDP is ridiculous. And, they could be just one event from having a lot of trouble. So at any rate, the banks, I don't think, are too excited about lower interest rates. And so they came down just a little bit, nothing to write home about, kind of steady. Okay, next one is the healthcare. And people have been hiding out at healthcare. Let's see if they're still doing it. And healthcare was up good, almost 1%. Again, that one's been taking off. Can you see? They got hit when everybody was talking about socialized medicine. And then bingo, people started saying that's not going to happen. And now, look, it's on its way. It's not that far from its 52-week high. So you can't keep a good sector down, apparently, and the healthcare looks like it's okay. Let's talk about communication. And on the communication front, communications are stocks like Google, Facebook, Verizon, Disney, Comcast, Netflix, all kinds of people like that. They were up a little bit today, but still have made that high up there. And so if they take out 90, I think you'd be in good shape. If they take out 80, it looks like that party might be over for a while. So there you get some pretty good lines in the sand. With regards to consumer discretionary, okay, well, that should be looking fairly decent if household spending's going well, but let's see what it looks like. I was up a little bit, nothing to write home about. Again, these things are up near their highs, so they need more gasoline to get going. And more gasoline, it would be in the form of, I guess, these earnings, the wages going up, the tariffs coming off, and things like that. But right now, it's hanging in there, not too far from its all-time high. The other one is called the staples. And, the staples, let me just get that up here for you. ABC. The staples when you're talking about consumers are stuff like Procter and Gamble, Coke, Walmart, Costco, those kind of things. All right. So anyway, that one was up a little bit today too. Again, it made a new high. Okay, but we'd like it to stay above that 150 mark, I think, because that was the former high. But we'll have to see. Definitely hanging in there, but nothing to write home about today. Very small percentage gain. All right, what other sectors? Oh, they were talking. The industrials were doing pretty good. Boeing got that big order from the company that owns Iberian Air, and that took Boeing up very big here. And right now, the industrial sector here up very minor. Okay, I'll get into my final viewpoint at the end of here and sum this thing up a little bit for you. Tech, VGT. How'd Tech do after this announcement? Tech hung in there a little bit, up 0.5%. Again, Facebook had been doing pretty good because of this announcement of the crypto Libra. But then there was some water thrown on it that there's a lot of testing that has to be done, approvals that have to go through, and that sometime in the future it could happen. So that took a little bit of the bloom off the rose there. But some of the other tech like Microsoft seems to always have a bid behind it, and even Apple's been on a little bit of a tear as well. But again, nothing to write home about. Seems to just be hanging out there. What else do we have here? Materials. Let's see if they seem like they're moving at all. Material companies, give you an idea, would be Dow, DuPont, Ecolab, Sherwin-Williams, these type of companies. Right now, what are you looking at there is down a little bit, so they're not too keen. Obviously, the inflation expectations being so low would be nothing to excite the material costs, right? All right, next one is utilities. People have been hiding out there, that's for sure. What are they doing? And they are up today strong again. So again, with the interest rate picture being lower, people are still bidding up the utility sector. And look at that. What did it go from like about 100? Let's see. Yeah, right around 110 all the way up to 135, plus it pays out just under 3. So bottom line is people have been interested in utilities during this, shall we say, shady period that we're in. The other place they've been hiding out is the REITs. So let's see if the REITs are still doing pretty good. That's the Real Estate Investment Trust. And let's see what the REIT does. Well, the REIT got a bid here today again, up near the high, just a little bit underneath its all-time high. But look what they've done since December. A lot of people going into these things. Why? Because they pay a pretty good yield, right? And they're backed by Real Estate Investment Trust. And so people have been optimistic about this. And they've been using it as a defensive tactic. Oil, let's see here. Oil. Down a little bit today. The oil prices are going back and forth, 50, 55. They break under 50 and you start seeing 4 handles. I think that could be a real problem. And if you get above 55 or 60, then it could be very much on the bicycle. So it's kind of trapped in a little bit of a range here. I would let the market dictate my activity rather than trying to be a predictor of it because, frankly, you can build a case either way. The fact that they're bombing boats in the Strait of Hormuz or the ocean and over there, I don't know exactly which area, but let's call it the Middle East, and we're not getting a jam out of here with them also cutting supply, is somewhat concerning. So the bottom line is the energy stocks have been on the defensive. Could they be making a turn? Well, they could be, but there's a gap there at 85. This thing started trading above 85, and if you started getting above 55 or so on the oil, I would be more in the camp that this thing might be making a turn. Otherwise, you got to be careful because overall the prices have been declining over time. Okay, so we are coming up here. Let me see. Okay, we got a few more minutes here. What else can I cover here for you quick to give you a little bit of an idea of what's going on? Let's look at some individual issues here that might be interesting for you. In the oil sector, people are looking at Exxon quite a bit. Let's see what Exxon looks like now. Yeah, Exxon is fading a little bit, so you got to be careful. I talked about this earlier. You need to get this thing. There's a gap up there that it might go for, but again, if oil doesn't take off, this thing could have some trouble. Let's turn towards one of the areas that I was looking at was the stocks involved in cloud and the payment processors. Again, one of the things that is threatening for the Libra crypto they're talking about is obviously to get into the payment processing department, which would be very concerning to Visa, MasterCard, and PayPal, among others. So let's talk real quick and look at some of the cloud companies. Adobe did great and was way up. Let's see if it maintained its strength. It was up, I think, yeah, 14 points. So we got a new high on it. Yep, new high on Adobe. So that one is looking strong. Their numbers were strong and they guided higher. So you can't do much better than that. And that's a gap up. Let's see if it continues or if it's going to come back down and fill that gap. But today you can't complain. Up 5.21%. Big day for Adobe. Did that spill over to the other cloud type stocks? Well, let's look at Twilio here and see if that got a bid because of it. And Twilio got a bid, yep, up 4. So that one's trying to break out again to a high as well. It is still underneath its high, but the momentum up almost 3% today. That's not bad momentum. Okay, next one after that I've been keeping an eye on is OKTA. And OKTA right now, today, did it get a bid under it? And yes, the cloud. So the cloud's back, bidding up the clouds. There's no doubt about it. Up almost 3%. And that's 132.40. Again, very close to the high, but not making a new high just yet. Let's talk about the next one that I keep an eye on here, which is CRM, Salesforce. You know, they had that acquisition, all stock acquisition. It went down to 150. Now it's coming back off 150. So you got a pretty good line in the sand on the drop down to about 150. If it can stay above this 148, 150 area ballpark, it could go into that gap up near 160. And then, of course, it does have a good bid like all the cloud guys do today, up 355. Certainly on more of the defensive than the other two that I just talked to you about. Amazon, of course, with their web services and other stuff going on, they've been getting a bid. And I would imagine they had a pretty good day today. Not too big, though, up 7 points. But you can see it has been going up. It has been going up, you see, from 1,700 to 1,900. Question is, can we take out this 2,000 area? And I think that question will be answered sooner rather than later because, again, this third quarter is going to be one that people are going to keep a close eye on. So keep an eye on Amazon because, again, it's a company that has a lot of different ways to make money. Next one are some of the payment companies. How are they doing here? You know, they had been running up pretty good. They were up a little bit, just under 1%, not too shabby, and not too far from their all-time highs. And again, retail sales were up, and according to the Fed, they believe household spending looks pretty good. And so when they're using their spending, they're probably using their Visa card, and that's a pretty good indication of that. So when you see Visa going up like that, looking for retail sales and household spending to be up is not far-fetched. MasterCard, probably same story. Let's see. Yep, same story. Up near their high, but still 10 points underneath. That tail, you wouldn't want that tail to get taken out at 255. I would say that wouldn't be very good if that happened. So that's something to keep an eye on. And then you got PayPal. And PayPal is up 1%. So they're very close to their all-time high too, 117, 118. Like I say, the market's up near 29.50, their all-time high. A lot of the strong stocks are up near their all-time high. Alibaba. Let's see how one of the big companies out of China is doing. They and Tencent through WeChat both have payment processing divisions that are very valuable to their companies as well. It jumped up, but now it's stalled out here today. Let's take a look at where it is here. It came down to that 150 number. I think that 150 number is very key. So that's a very good line in the sand right around 150. And then you've got the gaps that it's filling, right? It filled that gap. Maybe it's going to try to fill that gap around 175. But it does look like it's trying to make a turn. This low here is another one you'd like to have remain intact around the 158 area. So there's a couple lines in the sand there. And then, of course, if we get into 175 to 180, there could be some resistance there. You know, you would think that if we get a deal with China, this thing could go pretty good. So, again, keeping an eye on BABA has not been a bad idea. And it does seem to be trying to matriculate back to the upside. Okay, getting back to my opinion and my view for the rest of the week, and I'll be back with you on Friday. Thursday and Tuesday sometimes can be reversal days. And so I'm viewing tomorrow, Thursday, as a very, very important day. If they go up and they cannot take this 29.50 out, and if some of these stocks that I mentioned that are on their all-time high start rolling over, and if there is true disappointment on what the Fed is talking about, then, of course, I think we could get rolling over because we're up into the resistance zone. Conversely, it could be a binary event in that what? In that you could get this market to start trying to break through the top. Realistically, though, you'll probably see people try to keep a little bit of a cool head until we get through next week and get through the weekend where Trump and Xi meet and find out what the cards are going to look like. But I would expect volatility to be picking up rather significantly in the next quarter. That's July, August, and September. And so I always suggest people learn about hedging. Hedging using what? Covered call writing. Hedging using what? Collars. Combining covered calls and puts. Hedging using what? Married puts. Hedging using what? Replacement trades using calls, replacing long stock positions. How do they work? What would they do? What's the use? What's the risk? You can ask your clearing firms. You can also shoot me an email. OptionProfessor@gmail.com. OptionProfessor @gmail.com. Now, don't forget to tell your friends and other traders you know that they can tune into the broadcast by simply going to OptionProfessor.com, getting the link, and then they could listen to the weekly, or sometimes in this case bi-weekly updates that I provide for you. My opinion, my observations, and then you can obviously put it into whatever part of the mix that you'd like and use it against other information, and hopefully we can add something to your intelligence as far as what's going on right now in the market. Okay, big day today. We're going to have a big day, I think, the rest of the week, and we'll have to see what goes on Thursday, which again can be a volatile day, and I'll be back with you on Friday. So don't forget to tune in by going to the link on Friday after the close. Okay, have a great day, everybody, and again, we'll be back with you on Friday. Until then, good luck and good trading.